My name is Christopher. We deal with corporate commercial work. We also deal with litigation and dispute resolution, including arbitration. And there's a third limb of Colin Ng and Partners that deals with real estate and conveyancing transactions. Tax planning is important for SMEs as they seek to grow regionally and globally. It is important for awareness as to the different tax rules that applies to the operations that they are seeking to establish in these foreign jurisdictions. In mergers and acquisitions, typically companies look to either buy the shares of a company or the assets of a company. More often than not, the value of a company to some extent is derived on the intellectual property it possesses, whether by way of a trademark, a patent, or even the trade secrets that sit within the company's asset. For example, in a recent matter that I concluded, there was intellectual property being acquired from a sister company as part of the deal. In that deal, the value of this intellectual property would have given the company that was being acquired a significant tax deduction, which would have given an overall reduction in the total tax bill of that company being acquired. The second type of transaction that I typically deal with is that of joint ventures. Increasingly, we are seeing situations where one party provides the money or the capital and the other party provides intellectual property as their form of capital. And together, the two companies set up operations so as to commercialize the intellectual property that has been contributed by one party. And in this situation, tax planning is critical to ensure that the operational framework is matched up with the tax obligations in the different jurisdictions. The third element of tax planning that I tend to see becoming more important is that of transfer pricing. As companies grow and expand globally, more often than not, they will have subsidiaries in various jurisdictions. And in the course of their engagement with subsidiaries, there will be several, if not many, inter-party transactions. And these inter-party transactions need to be considered for tax compliance. This is especially relevant in light of the recent OECD guidelines that have been released on transfer pricing. Intellectual property tends to form the basis of many transfer pricing issues. More often than not, there will be a trademark, there will be license to a subsidiary, there will be maybe patents, and there might be trade secrets that are granted to the subsidiaries at no cost, depending on the type of transaction, whether it's a royalty, it's a payment for the use of services, or the payment for the use of IP. All of these may attract different tax implications depending on the country they're part of. It's essential to ensure full compliance with existing laws. More often than not, tax planning is seen as a compliance issue, and compliance becomes the focus of tax advisory work. However, there's a second element of tax planning that could be used as a growth driver. That is not to say that taxes are avoided or evaded. However, in careful planning of the operational framework of a group of companies throughout the region, tax can be managed and optimized to ensure that the correct taxes are paid. A common mistake made by many SMEs as they grow rapidly is to forget the substance of the transactions that they're dealing with. That is to say that when they're dealing with overseas parties or when they're dealing with different companies, to know exactly what the tax implications of the transaction are, not only in Singapore, but also in the country in which they're doing work in. In an increasingly global economy, it is important for companies to know not only their own backyard, but also in the playground that they play in.